and what they're planning on doing with interest rates. We just got that update from the Bank of Canada as of this morning. The press conference has been moved to tomorrow on March 9th. That's when we're going to get reporter questions. But today we're going to dive into the depths of what exactly the Bank of Canada is saying here and what this could mean for all elements of the Canadian economy. A video was released on the channel this morning that sort of talks about this in the context of real estate, but we're going to look at it from all angles today. And seeing some people hopping in the chat, let me know that you're here. If you're here live with me, it's good to see you. And let's get right into this and get into what exactly the Bank of Canada has just said. And then we're going to watch some videos on some analysis of this and break that down a little bit further as well. All right, let's dive in, folks. Here is the sort of statement that was released from the Bank of Canada. I'm going to throw these buckets on just for when we start watching videos. Take a look at this. All right, let me get to this to a sort of setting here so you can see it more clearly. Aha, I like it. I like it, that's pretty good. Okay, so let's get into it. The Bank of Canada today held its target for the overnight rate at 4.5%. Okay, so first off, we've got a pause. The pause is in. Some people were saying that they expected the Bank of Canada to go up another quarter of a percentage point, but they're keeping it as is for now, which is rather impactful, especially given what the Federal Reserve in the States is doing, which is, it seems like there's a fork in the road between what the Bank of Canada is doing and what the United States sort of equivalent is the Federal Reserve. We're going to get into that in just a moment. With the bank rate at 4 3/4 and the deposit rate at 4.5, the bank is continuing its policy of quantitative tightening. You've probably already heard of quantitative easing, right? That's what they did at the beginning of the pandemic, where they sort of created new money on their balance sheet to be able to purchase Government of Canada bonds with their mass bond purchasing program. And so that's quantitative easing, adding more money into the system by purchasing these Government of Canada bonds. But now they're saying, okay, we're in this era of quantitative tightening, which is just amounts to letting these bonds fall off of their balance sheet, right? At this point, it doesn't seem like they're selling bonds off of their balance sheet. They're just sort of letting them expire at their natural expiry date, right? Bonds will typically have a duration, 1 year, 2 years, 5 years, these types of things. So they're letting the bonds roll off their books now and continuing that policy of quantitative tightening. Global economic developments have evolved broadly in line with the outlook in the January Monetary Policy Report. Okay, so that's why they're pausing, right? That things have stayed on track for them in their mind. And global growth continues to slow, and inflation, while still too high, is coming down due primarily to lower energy prices. That's interesting because maybe they're not going to take that into as much consideration, because energy prices typically are the more volatile prices within the consumer price index, the CPI, and oftentimes those impacts on the CPI are trimmed out with CPI trim, sort of taking those most volatile elements out before they consider it. So who knows if they're going to read into that further. They say in the United States and Europe, near-term outlooks for growth and inflation are both somewhat higher than expected in January. Okay, yeah, so in the United States and Europe, okay. That's different from what we saw in Canada. In particular, labor markets remain tight and elevated. Core inflation is persisting, right? Core inflation, all right, is persisting. Growth in China is rebounding in the first quarter. This is after they've sort of stopped their lockdown measures, that their COVID zero policy that has really led to a contraction of their economy. But now, in reopening, they're saying, okay, we're seeing growth here again. People are saying that could be another inflationary pressure that we sort of didn't see, is the reopening of the Chinese economy. Growth in China is rebounding in the first quarter. Commodity prices have evolved roughly in line with the bank's expectations, but the strength of China's recovery and the impact of Russia's war in Ukraine remain key sources of upside risk, likely sort of pointing there at energy costs and the impact of the war on those commodity costs. Financial conditions have tightened since January, and the US dollar has strengthened. This is going to be something really interesting that we're going to talk about today, is the US dollar strengthening in relation to the Canadian dollar. The Bank of Canada doesn't specifically target a sort of a conversion rate, right? So it's not directly within their mandate, but it could influence what decisions they make in the future, especially as the Federal Reserve starts doing some different things here. Yeah, hey, great to see some new folks here in the chat and some familiar faces, Matthew and Kevin and G and Felicia with that fancy members badge. I love to see it. Bismillah and Ella and yeah, Matthew with Happy International Women's Day. Yeah, absolutely, Happy International Women's Day to everyone who's watching. All right, let's keep diving into this. Okay. In Canada, economic growth came in flat in the fourth quarter of 2022. We talked about this, how usually this is a bad thing for average Canadians, but in the Bank of Canada's mind, this is likely going to be something they point to and say, hey, we're doing a good job because we're slowing down the economy, which is what they want. In the fourth quarter of 2022, lower than the bank actually even projected. For the fourth quarter, with consumption, government spending, and net exports all increasing, the weaker than expected GDP was largely because of a sizable slowdown in inventory investment. Okay, less people buying things for their stores and for their businesses to stock up to satiate demand. Likely, if people think that there's going to be less demand and an economic contraction, then maybe you don't want to have as much inventory on hand that you could get caught with, right? That makes sense. Largely due to a sizable slowdown in inventory investment. Okay, got it. Restrictive monetary policy continues to weigh on household spending, and business investment has weakened alongside slowing domestic and foreign demand. This is what they've been looking for. They want slowing demand. That's the whole point of what they're doing, the whole point of them trying to break the back of the economy, right? But this is a point that we actually covered in today's video as well. I think a lot of you might be coming here to this live stream from the video that was released on the channel today. They say the labor market remains very tight. Employment growth has been surprisingly strong. The unemployment rate remains near historic lows, and job vacancies are elevated. Wages continue to grow at 4 to 5%, while productivity has declined in recent quarters. This is information that the Bank of Canada is actually worried about, right? Like all of the other data that we've been looking at kind of comes out as a positive for the Bank of Canada. Slower than expected GDP, a slowdown here in general, and inflation ticking down. Hey, G, thank you so much for the super chat. That's so nice of you to do and support the channel in that way. I appreciate it, G. Shout outs to G in the chat. Is it good for the Canadian bonds market? Do they pause or stop rate hikes? Yeah. Is it good for the Canadian? It depends on what you mean by good, right? Because of course, bond rates are inversely tied to those bond prices, right? So if we have rates going up, typically the prices of those bonds will go down because they're yielding a higher amount. So it sort of depends on what situation you're in. Yeah, MF James Dean says, I like that name, 4 to 5% is so weak and slow, specifically talking about this 4 to 5% right here about wage elevation, wage growth. This is higher than usual, right? In contrast to what inflation has been over the past year or so, maybe a little, maybe year and 6 months now, this is not very high, right? But when we consider historic wage growth, 4 to 5% is relatively high. And the reason the Bank of Canada is worried about this is because they see this as a potential input to more inflation, right? Saying that if we keep on seeing this high wage growth, this surprisingly strong employment growth, and incredibly low unemployment rates near historic lows, well, the Bank of Canada says all of that translates into potential for more inflation, which is their big enemy here. So they're watching this number really closely to try to figure out what the hell is going to happen in terms of inflation, and have they gone far enough in terms of rate hikes. Let's continue here because I think we're going to get more information. And thank you again, G, for the super chat. I appreciate the support for the channel. All right, inflation eased to 5.9% in January, reflecting lower price increases for energy, durable goods, and some services. Price increases for food and shelter remain high, and we've seen rent prices dramatically skyrocket, and interest costs on mortgage payments, which is something that's included in CPI, also is rather high as a result of what the Bank of Canada is doing, raising rates, and food price inflation as well, causing continued hardship for Canadians. With weak economic growth for the next couple of quarters, pressures in product and labor markets are expected to ease. Okay, this should moderate wage growth and also increase competitive pressures, making it more difficult for businesses to pass on higher costs to consumers. Okay, a couple key things in there. One, they're projecting a slowdown in terms of wage growth, right? They're expecting it to, in the next couple of months, slow down so that it's below the 4 to 5% range that they're seeing it as a result of this contracting economy that they're kind of manipulating, right, through their lower interest rate price, their lower interest rates that they're setting. And they say this should moderate wage growth. The other element here that we have to talk about is the fact that we should see an increase of competitive pressures, less people buying things, less demand, meaning that it's more difficult for businesses to pass on higher costs to consumers. This is the one area that the Bank of Canada has actually specifically commented on, and that applies directly to the whole grocery price inflation situation. They say, because of the high demand in Canada, which results in the high inflation, we are also seeing businesses pass on their increased costs more readily. So they're saying, grocery stores have seen increased costs, but in normal times with normal demand, they wouldn't pass on those costs, increase prices as quickly as they are today, where there's high demand. So even if they raise their prices, they're not worried about that going to a competitor, the business of the person who's buying there going to a competitor. Because if there's not enough supply to fulfill the demand, then it doesn't really matter. Like they're not afraid of losing their customers, which is what the Bank of Canada is saying they may be more afraid of doing now. Increased competitive pressures, making it harder for businesses to pass on to pass on those increased costs. Maybe for this, so you can sort of see a little bit. Let me. I'm gonna try to. Maybe I'll zoom out once more so you can see it if you're on a bigger. Actually, that's not much better, is it? Just some folks saying that they're having a hard time seeing all the words. I'm gonna leave it like this for now, and hopefully I can fill in the blanks if there's anything blocking it there. Okay. Inflation eased to 5.9%, more difficult for businesses to pass on higher costs to consumers. They say overall, the latest data remains in line with the bank's expectations that CPI inflation will come down to around 3% in the middle of the year. They remember their target is 3% by mid this year, 2% sometime in 2024. Year-over-year measures of core inflation tick down to about 5%, and 3-month measures are around 3.5%. Okay. Both will need to come down further, as will short-term inflation expectations to return inflation to the 2% target. Okay, interesting. At its January decision, the Governing Council indicated that it expected to hold the policy interest rate at its current levels, conditional on economic developments evolving broadly in line with the Monetary Policy Report outlook. Based on its assessment of this data, we've decided to maintain the policy rate at 4.5%. Quantitative tightening is complementing this restrictive stance. So they're saying we don't need to go as high with interest rates because all of these bonds that we were holding are rolling off of our books right now. There's less buy pressure in the bond market. As a result, people are having to pay higher interest rates on things like mortgages and all kinds of lending that are sort of roughly connected to the 5-year Canadian bond market. And it's complementing this restrictive stance. The Governing Council will continue to assess economic developments and the impact of past interest rate increases, and is prepared to increase, prepared to increase the policy rate further if needed to return inflation to the 2% target. The bank here's their strong language, the bank remains resolute in its commitment to restoring price stability for Canadians. They need to say that because they need Canadians to believe them, right? So that's interesting. That's interesting. Okay. Obviously a lot more to get into here. And we're going to switch over now to taking a look at some of the analysis that's gone on since this announcement was just released. I've got a couple of videos here that I want to show you, and we'll pause it and sort of comment on it along the way, and I'll give you my takes on what exactly is being said here. The first clip here is from BNN Bloomberg with their fast analysis as to what this rate pause means and how long they think it's going to actually continue.
Hello, welcome to Morning Markets. I'm Amber Kanwar. It is decision day for the Bank of Canada, and never has been an expectation of no change perhaps been more exciting, because it is the first time in 8 consecutive meetings that the Bank of Canada will put its conditional pause into practice.
Okay, it looks like they have like a little timer here, so let's just like flip forward to the end of that timer till we get that information. Let's go here.
Developments and the impact of past interest rate increases. They have said that they continue to do that, that they will assess economic developments and the impact of past interest rate increases, and is prepared to increase the policy rate further if needed to get inflation back to the 2% target. And that is exactly what they said in the last statement as well. So kind of apples to comparison. That was the key language shift the last time around.
This is an interesting chart, right? Because this is the reaction of the Canadian dollar to this announcement, right? And you can see that it's going down. And I think that the main reason this is because of the difference in stance between the two central banks of Canada and of the states, right? The Federal Reserve and Jerome Powell in the states versus Tiff Macklem and the Bank of Canada here. The Federal Reserve's getting even tougher on their inflation, even higher interest rate increases, or increasing for longer, right? Who knows what their end terminal rate will be. But that difference is largely what people are pointing to as, hey, maybe this is making the Canadian dollar lose a little bit of credibility, and as a result, be traded at a lower exchange rate.
You're seeing a little bit of a reaction in the Canadian dollar here. But again, we're not on an island when it comes to our interest rate decisions. We've got a great panel assembled for you to help go through what this means for you and your money. We've got Francis Donald, who's the global chief economist and strategist at Manulife Investment Management, and Kim Shannon, who's the founder and co-CIO of Siona Investment Managers. Ladies, thank you so much for being with me. I'll send it off to you first, Francis, to kick things off. We were expecting this. But just because we're expecting it doesn't mean there's not any nuance around it. What's your initial take?
And certainly just because the Bank of Canada looks like it does nothing does not mean the Bank of Canada is not very busy right now, probably in overdrive, trying to assess just how much impact these prior hikes are going to have on the economy. And this is really the game for the next several months, is how quickly is this economy going to slow down? Is the labor market going to follow it? And of course, is inflation going to follow suit and really see that slowdown in momentum moving forward? Now, you do have this issue that's occurring at the same time, which is a Federal Reserve that's still hiking. I don't think we should make too much of a big deal about this. We have two very separate economies. Yes, the Canadian dollar is in part driven by yields, but not solely driven by yields. In fact, what drives the Canadian dollar fluctuates over time. This is a Bank of Canada that knows 25 basis point hike in Canada can be more powerful and bring growth down more in Canada than the equivalent in the United States. So this is caution we're hearing from them.
It sounds like you agree that there shouldn't be too much made of a diverging path between the Fed and the Bank of Canada, Kim.
Well, keep in mind, I'm the bottom-up investor.
Yes.
I'm sitting beside an expert here overall. But, you know, the stability of interest rates and the ability of consumers and businesses to forecast how to operate going forward in the future is important. Yeah. But the big benefit for Canada right now is interestingly enough, inflation's a challenge and it's also an opportunity. And historically, Canada has outperformed other major markets when inflation's north of 4. So this isn't necessarily bad for investors in the Canadian stock market today.
I mean, you were talking stock market, and then there's the people in the economy, which I think for them, they have a hard time seeing how inflation is generally beneficial. And I hear your point that we shouldn't be making too much of a fuss of this divergence, but it is going to show up in that Canadian dollar. And as I mentioned, that will create a somewhat inflationary effect in this country. It sounds like you're saying it won't be outsized.
Well, what I'm saying is we should be cautious about saying that the only driver of the Canadian dollar is going to be rates, because oil can be a predominant driver. Mm-hmm. And over the past 2 years, the main driver of the Canadian dollar has been neither of those two macro factors. They've been general risk sentiment. So if we persist in an environment where risk, it still continues to be risk off, the stock market is doing poorly, that can lead to Canadian dollar weakness, even if the Fed did raise hikes. So we need to be careful not to try to punish the Canadian economy in order to target the currency. And I think this is what we're going to hear from the Bank of Canada in the next few days.
But yeah, and it's not even in their mandate, right, to really, at least to the best of my understanding, to target having a strong Canadian dollar. That's not something that they're hyper concerned about. They're concerned about, yes, stability of the Canadian financial system. That's what the Bank of Canada says that their main goal is, making it stable and making the financial planning for Canadians and easier by giving them a sort of stable footing here. But it's not necessarily a goal of theirs to keep this Canadian dollar, US dollar rate at any individual point, right? And here we can see the chart as of today. And we see like this pretty dramatic drop off here as people were sort of expecting the Bank of Canada to sort of continue with the pause in the language that they were giving prior to this announcement, and also hearing the language from the Federal Reserve. I think that that is largely what has caused this dip in the Canadian dollar. It's going to be interesting to watch how that plays out over the long run. We got another video here that I wanted to take a look at, and this is, again, all along the similar lines here. I'm going to go to this chat and make myself a little smaller here. Yeah, maybe we'll turn the chat off on this for a second.
Recent news out of the U.S. that the Federal Reserve has raised that benchmark rate 25 basis points, but the language out of the central bank suggests that ongoing rate increases will be appropriate. Very different language from the Bank of Canada, who have suggested a conditional pause.
Not very surprising. The Fed is still very hawkish in the language, and they have to remember, if you are the Fed and you start to be soft on inflation and you're saying everything is under control, guess what will happen to the bond market? Long-term interest rates will go down. They have to fight it because on the one end, they are raising interest rates to slow down the economy. On the other end, if you sound too optimistic about inflation and everything is fine and you are ending raising interest rates, that will lower long-term interest rates and will sabotage what they're doing. So they have to keep this kind of language, although maybe they're not meaning it. I think that what they have in mind at this point is one more move that will take the upper limit to 5% and they call it a day. But they cannot say it because the minute they say it, the bond market will react and will sabotage what they're doing. So they have to keep the market guessing. And that's, I think, what's happening now.
Yeah, that's interesting, right? And we talk about this a lot on the channel, is the forward guidance and the expectations that the language these central bankers use, that actually has an impact on the economy, right? And specifically on the bond market and the interest rates that people will pay for those bonds. If we see any central bank getting less strong on bringing down inflation, more dovish, right, than hawkish on the amount that they're going to raise interest rates, well, then the bond market sort of recognizes that and prices that in, lowering rates and lowering the yields on those bonds, which translates into the rates that people can get in the economy when they're lending and borrowing money. The reason this is an issue is because it could lead to an uptick in demand, right? If you have lower interest rates, people can borrow more for cheaper and spend more for cheaper, right? When you consider how people can sort of take out debt for a lower interest rate. So that's what they're afraid of, right? They don't want this double dip recession where we think we've got inflation under control, we start lowering interest rates or talking about lowering interest rates or even pausing like Tiff Macklem here is doing. And as a result, that leads to more demand and potentially another uptick in inflation. That's a worst case scenario for everyone involved, is seeing more inflation tick back up, because that means that these central banks will absolutely go balls to the wall in terms of their interest rate increases. It won't just be a quarter point here, a quarter point there. They're like, we need to squash this and get our credibility back.
Let's talk about that path of policy going forward. How long will we be in this wait and see situation?
Yes, so our call is that the next move will be another 25 basis points. And then, as I said, they will call it a day, they will rest. The question is, okay, you are at 5% upper limit. What next? When are you starting to cut interest rates? Usually, the gap between the last hike and the first cut is relatively short, a few months. This is not going to be the case this time around. I believe that the Fed will sit on its hand until early 2024. Why? Because they have to make sure that inflation is dead before they start cutting interest rates. You don't want to repeat the mistake of the 1980s where you had a double dip recession. You want to wait until inflation is absolutely dead. And if it means keeping interest rates higher for longer, so be it. Now, the market, and that's crucial, the market is now expecting the Fed and the Bank of Canada to start cutting in the second half of the year. To the extent that the market will be disappointed by that, that means that the bond market, and even to an extent the stock market, are a bit too optimistic about the first cut and therefore might be mispriced. We expect some correction in the bond market over the next few months as the market starts realizing that the Fed is not going to cut in the second half of 2023.
Let's talk about some of the data that has come out over the past few months on both sides of the divide and what the numbers are telling you and how that might play into the path for both central banks.
Well, first of all, inflation is improving. That's really good news. No, most of the improvement is in the goods segment of the market, reflecting the fact that the supply chain is improving. If you do a month over month on an annual basis, we are talking about a core goods inflation, outside the energy and food, is approaching zero. That's when it comes to goods. So it's all about services. And even there, you see some improvement. You see some slowing in the wage inflation in Canada and the US. So the inflation story is behaving. The move from 7% to 4% will be relatively quick. Maybe by April, maybe we will be there. The trick will be to move from basically 4% to 2%. And that's where the job market enters. And that's where we get numbers that are mixed. The vacancy rates in the US are still rising. So the market is tight. And therefore, wages will not go down as quickly as they hope in the Fed and the Bank of Canada. And that's the trick. So all eyes are on the job market that is still relatively strong.
Let's talk about.
Yeah, again, super interesting about talking about the labor market, right? Still a shortage of workers in many people's eyes. Still high wage growth relative to historical wage growth. This is what the Bank of Canada is worried about. I'm going to put a poll up here because I'm curious what you think, the folks that are tuning in and watching this. What should central banks do? Pause and wait and see. We need to raise rates further, or we need to lower rates relatively soon. I'm curious what you think about it. I'm going to drop that poll in the chat and you can respond as we watch here.
Rate sensitive sectors such as housing, and tell us what's happening on both sides of the divide.
Yes, so first of all, let's talk about the US. And the number one force to deal with is rent. Rent, listen to this, that's amazing. Rent accounts for 40% of core inflation in the US, 40%, which means that if all other prices will be zero, given the fact that rent inflation is 8% in the US now, it means that overall inflation, core inflation in the US will still be 3.8%, even if all other prices are zero. Now, that's the bad news. The good news is that the flow, namely new contracts, new leases, are now rising at the inflation rate of close to zero. So the stock is 8%, the flow is zero. So we know that it's a question of time until the stock will start going down because more and more of the flow will get into the stock, namely new leases will be more and more dominant. And that's important because that's, again, 40% of core inflation. So I'm optimistic about rent inflation in the US actually slowing down, helping the Fed in its fight against inflation. Now, Canada is different because we don't measure rent inflation this way. We don't measure housing inflation this way. Actually, one component is interest payments in our method. Interest payments are rising. So the Bank of Canada is raising interest rates to soften inflation. At the same time, interest payments that are part of CPI rising. That's why the Bank of Canada's life is a bit difficult to deal with. Having said that, clearly the housing market is slowing down, and it's slowing down relatively quickly. And that's a good thing because we went through 46% increase in house prices during COVID. If you don't see an adjustment, that's a bubble. So this adjustment is very, very healthy. It will continue, I believe, over the next few months. However, from a fundamental perspective, in a year, 2 years from now, we still have this huge demand coming. And as I suggested, official numbers underestimate the number of newcomers into this country. I estimate in 2022, roughly 950,000 people enter this country, new immigrants, non-permanent residents, foreign students, and people from Ukraine. Close to 1 million people, and none of them carries their house on their back. So clearly, we need some solution to this. The supply.
That's super interesting. Before we get too far away from it, I want to talk about the interesting way that that we measure inflation in housing in Canada. That's different from the way that we measure it in the US. One of the main things that's measured here in Canada is mortgage interest costs. And I think that measuring mortgage interest costs as part of CPI kind of skews the way that CPI goes in a pretty dramatic way, right? We saw this at the beginning of the pandemic when rates were so incredibly low. That also meant that mortgage interest rates were incredibly low as a portion of CPI. Now, as a result, that shows that inflation, it displayed inflation as lower than it probably actually was because it had incredibly low mortgage interest costs because that's what the Bank of Canada set interest rates at. Now we're on the total flip side of that, and it's a big difference, right? Well, I think that inflation is actually showing a little bit higher than it would otherwise if we measure this differently, because mortgage interest rates are so high, mortgage interest payments are so high, and that's how we measure housing largely in Canada inside of the CPI. So the very fact that we still have this high inflation is partially a result of the Bank of Canada trying to get rid of the inflation by having higher rates, resulting in higher mortgage interest costs that are tracked within the CPI.
Supply is not there. We are not building enough. In fact, we are building less. And that's something that will visit us 2 or 3 years from now. When the demand is there, the supply will not be there. So short term, this market is correcting, but it's not a free fall. It's not a meltdown. It's reallocation of activity over time. 2 or 3 years from now, we will see the pressure building because the supply is not there. The inventories are not there.
Benjamin, we've seen strong job numbers on both sides of the divide as we head into that summer season and that summer, I guess, seasonal job market. What is the expectation there from the labor markets?
Yes, that's a good point. But we have to remember one thing. One of the reasons why companies are hiring a lot of people is because of the fact that their existing labor force, many of them are actually sick. We cannot ignore this reality. The number of hours lost to sickness has risen dramatically in 2022, more than we have seen in 2021 and 2020 during COVID. People are sick. In the US, you have 16 million people with long COVID. And we have a tough winter. We all know the story. So in order to replace those people that are sick, you have to hire at least on a temporary basis. And that's why we see this increase. What it means, come spring, this will disappear because the seasonal aspect of the flu, COVID will be softer. And that's something that we have to take into account. So maybe the labor market is not as tight as perceived, given what we are seeing in the numbers. Nevertheless, wages are still rising, and the Bank of Canada and the Fed will keep interest rates high for longer to make sure that this housing market and this labor market starting to soften. And that's exactly what will happen over the next 6 months.
Interesting stuff there from Benjamin Tal on, I believe, on the Financial Post here. An interesting question here as well, or comment, James McNeil saying, Russell, doesn't make a difference in how you measure CPI as long as it's a consistent method of measurement. Yeah, I mean, that is true. Like, as long as you have a long-term period where this is the consistent way that things are measured, well, then you are able to take that into account, the way that things are measured. I was just sort of more pointing out the way that there's a sort of a counter pressure to whatever the Bank of Canada does on inflation when they change their interest rates because of the way that's measured on mortgage interest rate costs. And then James also says, can you say dollar cost average? I can say that over and over again, and that's what I do when it comes to investing whatever extra funds I end up with at any point is dollar cost averaging into the market over the long term. Nobody can really predict which way the market's going to go over the long term. If you could, then you wouldn't be needing to invest anymore because you'd already be a millionaire if you could actually time and predict markets consistently, right? So the best way to go about it, not personal financial advice, but it's to dollar cost average into the market, slowly trickle into some sort of low fee index fund that tracks the market, especially if you don't want to sort of have to do busy work to keep up your portfolio. So that's some interesting stuff here today. We got this. Oh, actually, let's close this poll. I didn't realize that it was still up. End poll. Let's see the results. Okay. Let me actually put this right here. I could show you what I'm seeing here. This is my little pop-out chat where I can see everything. Results. We've got, what should central banks do? We need to raise rates further at 47% of all viewers here. Pause and wait and see at 34%. A lot of people say, or 18% of people saying we need to lower rates. I'm definitely tempted to say that too when I look at my investment portfolio. I know lower rates would certainly help that. But in terms of getting inflation under control, it seems like folks are saying we need to pause and wait and see, or we need to raise rates further to make sure we get this under control. So interesting stuff to sort of see there. See your perspective on what you think. Yeah. And of course, a reminder here, tomorrow is now when the the Bank of Canada's speech about this is actually going to go down. Might be doing a live stream here. Keep your eyes peeled on the channel because we're going to cover that live. And like Motorhead says right there in the chat, if you haven't already, make sure to hit the like button on this video. It helps sort of spread it. We're going to call it a short stream there for today. I just wanted to go over my initial reaction on the Bank of Canada decision there, but keep your eyes peeled on the channel for more content just like this. Subscribe to the channel if you haven't already done so. I hope this video has been helpful to everyone, and I'll see you next time. Have a great Wednesday, everyone. We'll see you soon.